Right, welcome to this recording. The purpose of this recording is to identify our tax rules and the implication thereof on our different lease scenarios as per IFRS 16. You need to be familiar with your IS 12 principles to ensure that you understand this recording. I've divided our lecture material into 3 sections. Section number 1, we will briefly recap IFRS 16 recognition and measurement principles. Section number 2, we will look at the differences in terms of our accounting rules versus our tax rules. And in section number 3, we will identify when we apply these rules, what is the effect on our current tax calculation and our deferred tax calculation. Once we have identified that a contract is a lease as per IFRS 16, the standard indicates to us that in the records of our lessor, we need to identify if that lease is an operating lease or finance lease. We need to look at the risks and rewards. If your risks and rewards transfer to your lessee, you need to know that we need to recognize a finance lease. If the risks and rewards remain with your lessor, we need to recognize an operating lease. Operating lease, very similar to your IS 17 principles, our old lease standard. You need to straight line your lease payments and recognize the straight lined amount in your profit and loss. Therefore, in terms of your recognition, remember, our lessor will receive the payment. Therefore, debit bank increase, credit rental income based on your straight lined amount, and then your balancing figure will be recognized in a statement of financial position line item, income received in advance, an accrual, and so forth. Now, when we look at the finance lease, the standard indicates to us that we need to recognize our finance lease at net investment. Now, what is your net investment? To be able to determine your net investment, we first need to look at our gross investment. Our gross investment will be our lease payments plus our unguaranteed residual value. Now, remember, I'm not going to go into detail in terms of our measurement, okay? Therefore, basics, this will be your lease payments receivable by the lessor under the finance lease plus your unguaranteed residual value that will accrue to your lessor. Remember, we're busy with our lessor. Now, your gross investment, when you discount this by means of your interest rate implicit of your lease, you will calculate your net investment. And the difference between your gross and your net investment will be your unearned finance income. Therefore, the standard indicates to us recognize at initial recognition at net investment. Therefore, our journal entry will be to debit an asset, which is our gross investment in our finance lease amount. Then we need to credit our unearned finance income in our statement of financial position. And the difference between your gross and your unearned finance income, debit minus credit, will be your net investment. If there's any initial costs, credit bank account, decrease, and take out your asset. This is your journal entry on initial recognition. Then at year end, when payment is received, our lessor will receive the payment, therefore our bank increase, and we need to decrease our gross investment account. We need to recognize the finance income. Therefore, in our profit or loss, we will credit finance income increase and we will debit our unearned finance income. Now, when we look at the records of our lessee, remember, our lessee will receive the underlying asset from our lessor. Our lessee can choose an exemption recognition. Now, what is this? The exemption recognition enables the lessee to apply our operating lease accounting on this lease agreement. But it is important, guys, that the lessee can only apply the exemption or can only choose the exemption recognition if 1, this is a short-term lease, less than 12 months, or 2, this is a low-value asset. If our lessee chooses the exemption recognition, we need to apply our operating lease accounting. Again, guys, similar to IAS 17, our old leases standard, and we need to straight line our rental. I'm not going to do this, guys. I'm pretty sure you know this by now. When the exemption recognition is not applied, in terms of IFRS 16, we need to recognize a right of use of an asset and a lease liability. Right of use of your asset at cost, and our lease liability in terms of our future payments, and we need to present value this. But guys, I'm not going to go into detail in terms of the measurement. Remember, we need to recap the principles. Now, I've included a very, very basic example. In this example, we have an asset with a present value of 400,000, interest rate 12,1104, our lease term 4 years, and we have a payment of 132,000. We also have initial direct costs of 10,000. Now, on initial recognition, we need to recognize our right of use of our asset, and this will be 410. This is our 400,000 plus the 10,000. Debit the asset, increase in our asset. We need to credit our lease liability with a 400,000 and credit bank. This is an outflow payment of our initial direct costs. Remember, this is your initial recognition. Then at year end, your subsequent recognition, we need to recognize the depreciation on the right of use of our asset. Now, you will remember in terms of IFRS 16 paragraph 32, we need to identify if ownership will transfer to our lessee. If yes, you need to use the useful life of your asset to calculate depreciation. If no, you need to identify the shorter of either your useful life or your lease term, and then calculate the depreciation on the right of use of your asset. We need to remember to recognize the actual payment of our lease. Therefore, our lease liability will decrease. We need to credit our bank with a 132,000, which is our lease payment. Remember, we're busy in our lessee's records. And we will debit finance expense in our profit or loss, our subsequent recognition. Now we need to move on to our accounting versus tax rules of each of these different scenarios. Now, when we look at our lessor, this is on the left side of your screen. In terms of our accounting principles, we have included our rental income. Remember, when you look at your journal entry at the top, we have credited our rental income for accounting purposes. But for tax purposes, we need to include our lease payments. We need to remember our straight lining amount, guys. Why? Because for accounting purposes, we will have straight line amount, a line item in your statement of financial position, and we need to identify that there will be a temporary difference. And our leased asset, who is the owner? Our lessor. Therefore, this will have an effect on our deferred tax. Right, we are still busy with our lessor and our operating lease. Now we need to look at the implication in terms of our tax versus accounting rules in our income tax calculation. Now on the left side of the screen, you will identify I've included our accounting journal and our principles. Now, when we look at this, remember your basics in terms of IAS 12. We need to calculate our current tax and our deferred tax. To be able to calculate your current tax, you need to obtain your profit before tax from your profit and loss statement, and this is per your accounting rules. And then you need to take out your accounting rules and you need to include your tax rules to be able to calculate your taxable profit or loss. Now, when we look at this, you agree with me from an accounting point of view, included in my profit before tax amount, guys, this green amount, included in my green amount, I have my rental income. We are busy with our lessor. Therefore, included is my rental income. Now, my tax rules indicate that I need to include the lease payment in my taxable income. Therefore, the actual cash received, I need to take out my accounting rules. Therefore, I need to take out my rental income recognized per my accounting rules. Take this out, deduct. And I need to include my actual cash payment received. Then in terms of my deferred tax, remember currently who is the owner of this asset? Our lessor. Our lessor will be the owner of the asset. Therefore, in our current tax, remember we need to identify if there is any depreciation. Therefore, we will have to add back our depreciation and we will have to deduct any tax allowances. Guys, you see, I is 12, IFRS 16. You need to identify this, you need to know this. Now, when we look at our deferred tax, we will have a line item, our asset. We will include our carrying amount as per our accounting rules, our tax base as per our tax rules, and if there's a difference in terms of our depreciation and our tax allowance, there will be a temporary difference. This is not an IAS 12 lecture, guys, therefore I'm not going to go into taxable or deductible. Now, due to the straight lining, we will have a straight lining statement of financial position line item. It can be income received in advance or an accrual, and we will have to include our carrying amount for accounting purposes. And then we need to read the information provided in terms of our tax base and identify if there should be any amount included in our tax base, and there might be a temporary difference. Let's work through the different rules in terms of our accounting rules and our tax rules of our finance lease and the records of our lessor. For accounting purposes, included in our profit or loss will be our finance income, and for deferred tax purposes, included in our statement of financial position, we will have our net investment. In terms of our tax, the lessor will be taxed on the finance lease payments received, again the interest and the capital portion. For tax purposes, remember this lessor will be the owner of the asset. Therefore, the lessor might receive tax allowances on this asset. Now, let's have a look at the implication of this. Again, you will identify, I've included my journals at the bottom and the principles. Now, when you look at our income tax, the column of our finance lease, remember, we need to identify that we need to calculate our current tax and our deferred tax. Current tax, again, guys, we need to start off with our profit before tax. We need to take out our accounting rules and we need to include our tax rules. Now, when you think about your accounting rules, look at your journal entry at the bottom. Remember, we had to credit our finance income in our profit or loss. Therefore, this finance income amount is included in our profit before tax, our finance income, but we now need to take this out. Therefore, take out your finance income, and for tax purposes, we need to include our finance lease payment, the total payment, the interest and the capital portion. Therefore, include your tax rules plus your total payment amount. Okay? Now remember, and this is important, when you think about your initial journal entry, our lessor credited the asset, therefore they took out the asset. And we will now have to take out depreciation if any has been recognized, guys. Therefore, you need to read, you need to identify the scenario. You will have to take out depreciation if there is anything included in your profit before tax amount. And for tax purposes, we may recognize a tax allowance. Now, in terms of our deferred tax, for accounting purposes, we will have our net investment line item included. For tax purposes, remember, our lessor will be the owner of the asset. Therefore, for tax purposes, we need to include the tax base of our asset. And this will be the amount deductible in future against future economic benefits. And this will result in a temporary difference. Let's move on to our exemption recognition, our operating lease accounting. The difference in terms of our accounting versus our tax rules. Now, guys, very similar as per the operating lease of your lessor. We are just now looking at this from the lessee's point of view. Okay, so guys, I'm not going to work through the theory with you on this one. I'm going to look at the implication of the theory on our very basic scenario. Now, let's just take this one step back. Who will be the owner of our asset when we are busy with our lessee's records? Remember, we're busy with our lessee's records. Who will be our owner? The owner will be the lessor. Remember, our lessee is not the owner of this asset. Now, when we look at our operating lease, our calculation of our income tax, in our current tax, take out your accounting, include your tax. To be able to take out your accounting, what is included in your profit before tax? We have included our rental expense, the straight lined amount. Therefore, we now need to take this out. We need to add this back, a positive. In terms of our tax, we need to deduct the payment amount. Therefore, take out the actual cash paid. And then when you look at your deferred tax calculation, included in your deferred tax calculation, we will have to include our line item in terms of our statement of financial position, the prepayment, or the amount that relates to our straight lining, the difference between the actual payment and the straight line payment. And you need to include your carrying amount. There might be a tax base depending on the scenario. Therefore, you need to read this. And then there might be a temporary difference. Okay, pretty straightforward, guys. But you need to know your IAS 12 principles. Now we need to look at the lessee when our lessee recognizes a right of use of our asset and a lease liability. Please ignore the VAT section, guys. I've included this for completeness purposes. Ignore the VAT section. We need to assume that that is not applicable in this discussion. In terms of our accounting principles, for accounting purposes, when you look at my journal entry, we have deducted depreciation. Therefore, depreciation is included in my profit and loss. For accounting purposes, we have deducted our finance expense. Therefore, finance expense is included in my profit or loss. But for tax purposes, guys, who is the owner of this asset? The lessor. Therefore, for tax purposes, we may not claim a tax allowance on this asset. Guys, you see, we may not claim a tax allowance, but we can deduct the full installment of the lease, the actual payment of the lease. Therefore, this 132,000. Our depreciation is the 102,500. Our finance costs 48,442. Now, in terms of our deferred tax, included in our deferred tax, we will have a line item, our lease liability, and we need to include our present value, and we will have a line item, our right of use of our asset, and we need to include our carrying amount in terms of our accounting rules. In terms of our tax rules in our deferred tax, remember guys, when you look at the lease liability, remember your tax base of a liability, not lease liability, but of a liability, will be your carrying amount minus the amount deductible in future. Therefore, your tax base will be 0. Your asset tax base will be 0. Why? Because your lessor is the owner of this asset, not your lessee. Therefore, there will be a temporary difference and you need to apply your IAS 12 principles, taxable or... Right, let's apply these principles to our income tax calculation, our current tax and our deferred tax. Again, I've included the journal and the principles on the right side of your screen. Now, when we look at our current tax calculation, as always, we need to take out our accounting and we need to include our tax. Now, when you look at your journals, you will agree with me that we have included our depreciation in our profit or loss, and we have included our finance expense. But for tax purposes, we are able to deduct the full installment of the lease. Therefore, if we take out our accounting rules, we need to take out our depreciation. We need to add this back, the 102,500. We need to add back our finance expense. This is a plus. Add back 48,442. And we are able to deduct the full installment, the payment. Take this out, and this will be the 132,000. Now, when we look at our deferred tax, remember, on our statement of financial position, we will have 2 line items, right of use of our asset and our lease liability. The right of use of our asset will include our carrying amount for accounting purposes. Therefore, for accounting purposes, this will be the 410,000 on initial recognition minus the 102,500. And our carrying amount for accounting purposes will be 307,500. Our carrying amount of our lease liability for accounting purposes will be the initial 400,000 minus our journal entry 83558. And this will be 316,442. Now, we need to look at our tax base of our right of use of our asset. Now remember, who is the owner? Our lessor. How do we calculate the tax base? Your tax base of your asset will be the amount deductible in future for tax purposes. Therefore, 0, nothing will be deductible in future. Why not? Because our lessee is not the owner. And you are able to calculate a temporary difference. When we look at our lease liability, how do we calculate the tax base of a liability? This will be the carrying amount minus the amount that will be deductible in future. Now, our carrying amount, 316,442. And in future, when you look at your current tax calculation, we may deduct our payments. Therefore, in future, we may deduct all of our payments. Therefore, we are able to deduct the 316,442. And this will be 0. And our tax base for our lease liability will be 0, and therefore there will be a temporary difference. Okay, so guys, this is the end. You need to still remember if there is any VAT, the implication of VAT, and if there is an installment sale agreement, what is the implication thereof. I really do hope that you found this recording helpful and that you are able to remember the different treatments in terms of our tax.